Good morning, friends. I am Dr. Biswo Mishra. Today we will discuss regarding Financial Management Block 2. Course code is MMPC 14. Friends, today we will discuss the concept called cost of capital. What will be our scheme of discussion? Let me first tell. First, we will discuss regarding cost of capital. Then we will give an introduction on cost of capital. Then we will discuss regarding different components of cost of capital. Next, we will discuss regarding classification of cost of capital. Next, we will discuss significance of cost of capital. Next, we will discuss different components of cost of capital. We will discuss cost of long-term debt, cost of preference capital, cost of equity, cost of retained earning. And at last, we will discuss weighted average cost of capital. Then we will discuss some keywords and we will wind up our discussion. Friends, first we will discuss cost of capital. In any business, we require capital. The capital will be introduced by either the owner, he will invest his own money, or he will take a loan. So in a business, there are two types of capital. Either there is own capital or there is loan capital. If you invest loan capital, you have to pay interest. So simply, the interest is the cost of loan capital. But what is the cost of own capital? The owner invests his own money. Is it cost free? Whether there is any cost attached to it? Yes, definitely. The owner may have invested the money which he have invested in the business somewhere else, and he might have earned some income. That income he is losing, plus he is putting extra efforts in the business. Hence, he should expect more than cost of debt. So, cost of equity is the opportunity cost. Generally, the cost of equity is more than cost of debt. So, we have discussed this. Cost of debt means interest cost, and cost of equity is based upon opportunity cost of capital. And cost of equity is generally greater than cost of debt. So, our conclusion is cost of equity is greater than cost of debt. Why cost of equity is greater than cost of debt? Because the owner might have earned the cost of debt by investing, by lending the money which he have invested in the business somewhere else. Plus, he is putting some extra efforts. He is taking some extra risk. Therefore, cost of equity is greater than cost of debt. So, what is cost of capital? So, cost of capital is the cost of obtaining funds for the business. So, it's the minimum rate which a business should earn from the investment he made. So, cost of capital is the cost minimum required rate of capital. The person who invests money in the business, they expect something. The minimum expectation of the providers of capital is known as cost of capital. In business, many persons have invested their money. Debt holders have invested their money. Preference shareholders have invested their money. Equity shareholders have invested their money. Term loan providers have invested their money. They expect something from the business. That minimum expectation is known as the cost of capital of the business. So cost of capital is the minimum expectation of the provider of capital. It is the minimum rate which a firm must earn. Otherwise, its price, its value will go down. If this particular minimum rate, if cost of capital of a business is 10%, if the firm earns 10%, then its share price or its value will remain intact. If a business earn more than cost of capital, then its value will increase. If a business earn less than cost of capital, then its value will decrease. Hence, cost of capital is the rate of return which a business must at least earn. It's the minimum rate. It is the required rate which each business must earn. So, cost of capital is the cost of long-term funds. While calculating cost of capital, we generally do not consider cost of short-term funds. Because short-term funds are invested in the business for a small period of time. 1 month, 2 months, though they have cost. While calculating cost of capital, we only consider cost of long-term funds. Long-term funds includes term loan, long-term funds includes debentures or bonds, long-term funds includes preference capital, long-term funds includes equity capital, long-term funds includes retained earning, plowing back of profit. So this is cost of capital. So cost of capital is the minimum rate. It is the minimum expectation of the provider of capital. Cost of capital is always related to risk. More risk a person take by investing in the business, he will expect more. The risk of debenture holder and equity holder are different. Debenture holders are taking less risk, hence debentures cost is less. Equity holders are taking more risk, hence the cost of equity is more. So it is totally related to risk. Generally, risk may be of two types. One is business risk, another is financial risk. What is business risk? Each and every business has certain risk. It's the risk associated with each business. The risk associated with every business is its business risk. Next, what is financial risk? So, financial risk occurs if you adopt an improper financial mix. It's the possibility that the business income may not be sufficient to meet the obligation of the debt holders. If a firm is not able to meet its financial obligations, it is known as financial risk. So we have discussed two types of risk, business risk and financial risk. Next, what are the classification of cost of capital? There are two important ways in which cost of capital may be classified. One is known as explicit cost. Another is known as implicit cost. So what is explicit cost? Explicit cost is the discount rate that equates present value of cash flow of a instrument with present value of cash outflow. I am giving an example to make it clear. Let's take an example. Suppose a company issues a bond. It issues the bond at a face value of 1,000. So company gets 1,000 by issuing bond. And it's a 5-year bond. And the interest rate is 10%. Coupon rate attached to the bond is 10%. If the coupon rate attached is 10%, every year it has to pay interest 1, 2, 3, 4, 5. In 5 years, it has to pay interest. In first year, it will pay 100. Second year 100, third year 100, fourth year 100, fifth year it will pay 100 plus it will return back the money, that is 1000, 1000, 1100. So these are inflows associated with the bond, inflows of the bonds. These are the outflows of the bonds. You have to pay these. And the inflow is 1000 which you get. So inflow of the bond is 1000 and outflows are a series of outflows. 100, 100, 100, 100, 1100, series of outflows. If we will discount it at a rate at which the present value of all these outflow will be equal to 1000, that rate, that discount rate is the explicit cost of the bond. So what is explicit cost of the bond? Explicit cost is a discount rate that equates present value of cash inflows of an instrument with present value of cash outflows of the instrument. So this is the basic thing, this is the basic funda which you will apply while calculating the cost of any source. Whether it's cost of debt, whether it's cost of equity, whether it's cost of preference capital, we'll apply this particular explicit cost concept. Explicit cost simply means it's the discount rate which equates the present value of cash inflow with the present value of cash outflow. Next, we will discuss implicit cost. There are certain instruments which do not have any explicit cost. Let's take an example. You use the self-generated money or you used the retained earning. In that case, there will be no inflow and outflow. But in that case, you will consider the opportunity cost as its cost. Hence, implicit cost is simply the opportunity cost. Explicit cost is the discount rate which equates the inflow and outflow. Present value of inflow with present value of outflow. That is explicit cost. And implicit cost is basically the opportunity cost. Explicit cost is the cost related to funds, while implicit cost related to cost related to use of funds. So we have to consider implicit cost and explicit cost, and implicit cost is just the opportunity cost of capital. It's the opportunity which the provider forgone by not investing the capital in alternative investments. Hence, this is known as implicit cost. Next, we will discuss what is the significance, what is the importance of cost of capital, why we will calculate cost of capital, why cost of capital is required, what are the reasons. Cost of capital is the basis, provide the basis for financial appraisal of new capital expenditure proposal. What is capital expenditure proposal? Suppose a business has certain projects to do. It wants to invest in some project, new capital, new project. Business has to do. In that case, the new project will generate some inflow and the new project will generate some outflow. So we have to discount those inflows and outflow at a rate. That rate is known as cost of capital. Hence, cost of capital is used as the discount rate for capital expenditure decisions or for capital budgeting decision. Cost of capital also helps in designing the best capital structure, that is optimal or best capital structure. Cost of capital is used to evaluate the financial performance of the management. Management must earn a return more than cost of capital. If the management earns return more than cost of capital, it means the ROI generated in the business is more than cost of capital. then only the value of the firm will increase. Hence, when the shareholders evaluate the performance of the management of the business, performance of the directors of the business, they evaluate whether the directors could earn a cost more than the cost of capital of the business, whether the ROI of the business is more than the cost of capital. Next, in taking dividend policy decisions, also cost of capital is used. Cost of capital is also used as a capitalization rate. When we calculate the value of the firm, we discount it with a rate. We capitalize it. The capitalization rate used is known as cost of capital. Generally, we calculate the value of the firm as EBIT by cost of capital. So cost of capital is used in valuation of firm. So next we will discuss how to calculate cost of capital. First, we will calculate the cost of individual source of capital or individual source of funds. First, we will calculate cost of individual source of fund. What can be the individual source of funds? The individual source can be debenture or debt. We will first calculate cost of long-term debt or cost of long-term debenture. We may call it as KD. Then we will calculate cost of preference shares. We can call it as KP. Then we will calculate cost of equity shares. We can call it as KE. Or we will calculate cost of retained earning. We will call it as KR. So first we will calculate KD, KP, KE, KR. Then what we will do? We will find out the average. We will find out its average. Its average is known as, we will find out its average. Its average will be known as overall cost of capital. That is known as KO. So we will calculate KO or overall cost of capital of the business. So first we will calculate cost of long-term debt. How to calculate cost of long-term debt? Generally, we know that to long-term debt holders, we generally provide interest. So the interest is the cost of long-term debt. But when we pay interest, interest is a charge against the profit. Interest is put as an expenses in the profit and loss. If we put interest in profit and loss, the profit of the business will come down. Once the profit comes down, we have to pay less tax on it. So while paying interest cost, we are saving some tax. Why? Because if we raise money by issue of debt capital or long-term debt, we have to pay interest. And interest is an expenses. It will be put in PL account. Once it is put in PL account as an expenses, the net profit before tax will come down. If profit before tax comes down, profit after tax or PAT of the business will come down. Hence, we have to pay less tax if we pay interest. So there is some tax saving by paying of interest. That concept is known as tax shield. What is tax shield? Tax shield means tax saving due to interest. Tax saving due to interest. If you pay interest, you save some tax. And this concept is known as tax shield. So while calculating cost of debt, we have to consider the tax shield. Hence, the cost of debt is equal to 1 minus T into R. What is R? R means interest rate. Let's take an example. Suppose you look at this example. Suppose a company, example, this particular example we will solve. Suppose a company has issued a debenture carrying 10% interest. tax rate applicable is 40%. Find out the cost of debt. Simply, a layman will tell the cost of obtaining debenture is 10% because R is 10%. But for a finance people, I have told that by paying 10% tax, 10% interest, I am saving some tax. That concept is known as tax shield. So I have to adjust the tax shield concept while calculating the true cost of debt. So I will apply this particular formula. 10% is R. I will put into 1 minus T. That is 10%. Whole into, if the tax rate is 40%, 1 minus tax rate is 0.40. That is equal to 10% into 0.60. That comes to 6%. So the effective cost of debt will be 6%. So my first point is, my first submission is, while calculating cost of debt, we have to make adjustment for tax. Again, the debt may be issued at par or premium or discount. If 100 rupees debt is issued at 100, it is known as par. If 100 rupees bond is issued more than 100, it is premium. If 100 rupees debt is issued less than this 100, that is discount. So we have to consider the component of premium and discount on issue while calculating the cost of debt. So if the debentures are issued at premium or discount, if it is issued at par, this formula is okay. If it is issued at premium or discount, we have to twist the formula a little bit. The same concept will be there. KT is equal to R whole into 1 minus T whole divided by NP. You can call it R or you can call it I. In some books it is written R, in some books it is written I. RI, same way, that is interest rate. So same concept will be there, but you have to consider net proceeds here. What is net proceeds? Net proceeds means the proceeds you get by issue of debentures. That is net proceeds. Let's take an example. A company issues 10% irredeemable debenture. What is irredeemable debenture? The debenture which will not be redeemed in near future. It will be only be redeemed at the time of liquidation of the company. Irredeemable debenture do not have a lifetime. Redeemable debenture have a lifetime. So a company issues 10% irredeemable debenture of 1 lakh. The company is in 60% tax bracket. 10% means 1 lakh, 10%, 10,000 is the interest. Whole into 1 minus tax rate to concept give the effect of tax shield by net proceeds. If it is issued at par, net proceeds will be 1 lakh. If it is issued at 10% discount, it will be 1 lakh minus 10%, 90,000. If it is issued at 10% premium, it will be 1 lakh plus 10,000, 1 lakh 10,000. That means you have to consider the term of issue while calculating the cost of debt. Next, most of the debentures are generally redeemable in nature. If those are redeemable in nature, then we have to consider the concept of redemption, term of redemption while calculating the cost. What can be the term of redemption? The debenture may be redeemed at par or at premium. So we have to consider, in case of redeemable debenture, we have to use this particular formula to find out the cost of debt. What is the formula? The formula is cost of debt, KD is equal to cost of capital, I whole into RV minus SP by N whole divided by RV plus SP by 2. What is the concept? KT is equal to I means interest rate, plus RV minus SV. RV means redemption value. SB means net proceeds. Divide by N. N means life of the debenture. And we have to give the tax shield benefit in here. Whole into 1 minus T. Whole divide by RV redemption value plus net proceeds by 2. And we will use this particular concept to find out the cost of redeemable debt. And this particular example, if you will solve at home, you will see that how you consider the cost of redeemable debt. Next, we will discuss a particular concept called YTM. What is YTM? YTM means yield to maturity. This is the IRR of a bond. This is actually the explicit cost of the bond. What is explicit cost? We have discussed. It is the discount rate which equates the current price of the bond with the future cash flow associated with the bond. It's the explicit cost of the bond. YTM equates the present value with the present value of outflow of the bond with its current market price. That is known as YTM of the bond. So next, we will discuss another concept, that is cost of preference shares. What is cost of preference share? Generally, preference shares holders give money to the business and they expect something. That something is known as preference dividend. So while calculating the cost of preference share, we have to consider preference dividend. And we have to consider net proceeds. Net proceeds means, suppose you issue preference shares, 100 rupees preference shares at par or at premium, and there are certain issue expenses. So 100 rupees preference share, it is issued at 10 rupees premium, 100 plus 10, 110, and there is issue expenses too. So 110 minus 2, you get 108. This 108 is known as net proceeds. So how to calculate cost of preference capital? Cost of preference capital is the minimum expectation of the preference shareholder. What is cost of debt? Cost of debt is the minimum expectation of the debenture holder. Similarly, cost of preference share is the minimum expectation of the preference shareholders. So how it is calculated? It is calculated with the help of following formula. Cost of preference capital is equal to preference dividend divided by face value minus issue cost, which we call it as net proceeds. We will calculate net proceeds. We have discussed. Let's take an example. A company is planning to issue 9% preference share at a price of 85. 85 means it is issued at a discount. The cost of issuing and selling the shares are 3. That means what is the net proceeds? You issue the share at 85 and you incur an expense of 3. That means net proceed is 82. And what is the face value of the share? Face value is 100. And what is the preference dividend? It is 9% preference dividend. Always preference dividend is calculated on face value. So this is 9% on 100. So dividend you get is 9. Now you will find out the cost of debt. You will calculate the cost of debt. If it is 100, then it is 9. If the face value is 85, then it will be 85. 9% on 85. We do not know. It is not given in the question. Question, it is given 85 at par value. It means the book value of the preference share is equal to 85. And what is the preference dividend? Preference dividend is 9%. So what is preference dividend? preference dividend is equal to 9% of 85. If it is not given, then we will assume it is 100. It is given, it is issued at par. So what is the preference dividend? Preference dividend is 7 rupees 65 paisa. And what is the net proceeds? You issue the preference share at 85 and you incur a expenses of 3, that is equal to 382. So you calculate cost of preference capital as dividend by net proceeds. 7.65 by 82, you get 9.33% as its cost. So we have discussed how to calculate cost of preference share. Next, we have discussed how to calculate cost of debentures. Next, we will discuss how to calculate cost of equity capital. Very important. Cost of equity capital is very important. As per Van Horn, cost of equity capital can be thought as a rate of discount that equates present value of all expected future dividend as perceived by investor to its current market price. This definition tells regarding the explicit cost concept. Suppose you buy the share of Reliance and Reliance will provide you dividend for next, let's suppose next 20 years. You want to plan to hold the share. And every year Reliance will provide you some dividend. And 20 years afterwards, you will sell Reliance at a price. You have to expect all these things. And you have to discount it at a discount rate, which will equate all these cash inflows with the current market price. And that particular rate will be cost of equity capital. But calculation of cost of equity is very difficult. Why it is very difficult? Because you have to estimate the dividends. You have to estimate the expected sale price after the holding period. Hence, there are certain formulas which you will apply and find out cost of equity. We will calculate an approximate cost of equity, not the exact cost of equity. Exact cost of equity will be the explicit cost of the equity. So we will find out the approximate cost of equity. There are many methods of finding out approximate cost of equity. One method is earning price ratio method. In this method, cost of equity is measured by earning price. What is the formula? Cost of equity. Cost of equity is equal to KE is equal to earning, current earning by current market price. Current earning by current market price. Suppose EPS of a company is 10. EPS means earning per share. And current market price of the company's share is, let's take an example, 100. So what is cost of equity? This theory tells EPS by market price into 100. EPS is 10, market price is 100 into 100. So it is coming 10%. So this particular method calculate cost of equity with the help of EPS, earning price ratios. Next, there are other methods for computation of cost of equity. One is earning price plus growth rate method. In many companies, people expect that, investors expect that its earning will increase year after year. In that case, that particular method, we have to apply this particular theory or this particular formula. This method considers growth in earning. And we apply KE is equal to E0 whole into 1 plus BQ by P0 as the formula to calculate EP, earning price ratio plus growth rate ratio. You can see its example. Next, some people calculate cost of equity with the help of DP ratio. DP ratio method. In case of DP ratio method, cost of equity is calculated with the help of dividends. That is, cost of equity is equal to DO by PO into 100. What is DO? D means dividend per share. PO means market price per share. Let's take an example. The market price of equity of a share is 15 and the dividend rate is 15%. Par value is 10. So what is dividend? Dividend is equal to 15% on par value on 10, that is equal to 1.5. And what is the cost of equity? We will apply this particular formula. DPS is 1.5 by market price is 15 into 100, it's coming 10%. So DP ratio, you can use DP ratio. There is another variety. There can be DP ratio plus growth. In that case, cost of equity will be calculated with the help of particular formula. The formula is P is equal to D1 by KE minus G, or KE is equal to D1 by PO plus G. You have to apply this particular formula to find out DP plus growth rate method. Next, you can also find out cost of equity with the help of realized yield method. The most important method used to calculate the cost of equity is security beta method. It is also known as CAPM method. What is CAPM? Capital Asset Pricing Model. Capital Asset Pricing Model. CAPM method. CAPM method attach risk to cost of capital. CAPM method tells there are two types of risk. One is known as systematic risk. Another is known as unsystematic risk. What is systematic risk? What is unsystematic risk? Systematic risk is the risk by which each and every player of the market is affected. It's market risk. Unsystematic risk is unique risk. Systematic risk, unsystematic risk. Inflation is something which affects all the companies in the market. Recession is something which affects all the companies in the market. So these are systematic risks. But a strike in a company affects only that particular company. Strike, lockout, employee dropout. These are unsystematic risks. But systematic inflation, exchange rate fluctuation are systematic risks. So CAPM model tells that systematic risk is the actual risk, because unsystematic risk can be reduced through diversification. If we put our money in more than one security, our unsystematic risk will reduce. But what will not reduce? The systematic risk will not reduce. Hence, systematic risk is the actual risk. And this systematic risk is calculated with the help of beta. Hence, this particular method attach beta to calculate the find out the cost of equity. So in this case, how cost of equity is calculated? Cost of equity is calculated with the help of a formula. What is the formula? Formula is cost of equity is equal to RF plus beta I whole into RM minus RF. This is the case. What is K? K is cost of equity. What is RF? RF means risk-free return. This is a risk-free return. What is beta I? Beta means this is the beta value of the security. RM means market return. And RF means, we have already discussed, risk-free return. The risk-free return means the return which you generate by investing in government securities. The risk-free rate of a T-bill of RBI is 4%. RF is given 4%. The return on security X is 12%. And average for average 5 year, the beta value of the X is 1.4. X is equal to 1.4 and market return is given 12%. You have to find out KE. KE is equal to RF means 4% plus beta I means 1.4 into RM minus RF. RM means 12 minus RF is 4. And you find out the value is coming 15.2%. So the best method for calculating cost of equity is CAPM model, capital asset pricing model. It attaches the cost with the risk. Next, we will calculate cost of retained earning. What is cost of retained earning? Generally, there are certain profits which we do not distribute, but we reinvest it in the business. It's the cost of plowing back of profit. So it's the cost of retained earning. So what is the cost of retained earning? In this particular case, you cannot apply the explicit concept of cost. You have to apply here the implicit concept of cost, that is the opportunity cost concept to find out the cost. Generally, Professor Solomon has found out a formula to find out cost of retained earning. By applying opportunity cost, the formula of cost of retained earning is KR is equal to KE whole into 1 minus TR whole into 1 minus B. KE is cost of retained earning, cost of equity. TR means tax holders tax rate and B means brokerage cost. And you will apply this and you will find out the cost of retained earning. So up to this, we have calculated cost of individual source of capital. Now we will calculate cost of the entire firm, that is known as weighted average cost of capital. We have calculated KD, we have calculated KP, we have calculated KE. And now what will we have calculated KR? Now we will find out the weighted average of all these things. And we will find out the weighted average of all these things that we will get, that is known as weighted average cost of capital or overall cost of capital, that is symbolized as KO, or it is also known as composite cost of capital. So composite cost calculation involves certain steps. There are 3 steps we generally calculate for calculation of weighted average cost of capital, overall cost of capital of the entire firm. What are the steps? In step 1, we calculate cost of individual source of capital. What are the cost of individual source of capital? Either it will be KD, it will be KP, it will be KE, it will be KR. Then in step 2, we calculate weight of each source. But what is weight? Weight means proportion of investment. Weight means importance. Weight is equal to importance. We calculate importance. Importance means proportion of capital. And step 3, we calculate cost into weight. Sum total of cost into weight. Cost, we multiply cost with weight and summation it, and we get the weighted average cost of capital. Now the concept arises, what is weight? Weight means importance. Weight means proportion of each source of capital. percentage of each source of capital in the total capital structure of the company. The weight can be of two types. It can be either book value weight or market value weight. That means you can use book value to find out the weight, or you can use market value to find out the weight. The formula of weight is very simple. That is called to individual value divided by total value. That is called to weight. Individual value divided by total value. That is called to weight. Now we will find out, solve a problem on weighted average cost of capital. Now there is a controversy. Which weight do we have to use? Book value weight or market value weight? Friends, market value weight is the true indicator of the worth of a particular source. We should better use market value weight, but book value weight is easily available. Hence, people normally book value weight is very popular, not scientific. Market value weight is bit complex but scientific. So we will solve a problem for calculation of weighted average cost of capital. Let's take an example. A firm has the following capital structure. It used debt of 20 lakhs, preference capital of 10 lakhs, equity share of 30 lakhs, retained earning of 40 lakhs, and the total capital of the firm is 1 crore. And what is its proportion? What is its percentage? What is the percentage of debt in total capital? 20 lakhs by 10 lakh, that is equal to 20%. So its weight is 0.20 or 20%. Preference capital, what is its weight? 0.10. And what is the weight of equity? 30 lakhs by 1 crore, that is 0.30. And what is the weight of retained earning? 40 lakhs by 1 crore, that is 0.40. You get proportion, you get weight. And each source has a cost. Debt's cost is 4.50. KD is equal to 4.5. Cost of preference share, that is KP, is equal to 9. Cost of equity is equal to 11. And cost of retained earning is equal to 10. So you get cost, you get weight, you just multiply cost with weight and sum it. You will get weighted average cost of capital on the basis of book value. How we will solve it? Debt is given, proportion or cost is given. What is debt's weight? We will write it weight. Proportion is okay. Weight 0.20, 0.10, 0.30, 0.40. What is the cost? The cost of debt is 4.5%. Cost of preference share is 9%. Cost of equity share is 11%. Cost of retained earning is 10%. What you will do? You will just multiply weight into cost. Weight into cost. Weight is 0.20 and cost is 4.5. 0.20 into 4.5. 4.5 into 0.2, that is equal to 9%. I can write it 9%. Or 0.9%. Similarly, preference share 0.10 into 9, that is equal to 0.9. This is 0.30 into 11, that is equal to 3.3. Then 0.40 into 10, that is equal to 4. If you will add all these percentage, you will get 9.10%. And this 9.10% is the weighted average cost of capital. It's the overall cost of capital, or it is the composite cost of capital. In this case, what we use? We use book value. Instead of book value, if you will calculate the market value of each source, you will calculate the market value of debt, calculate the market value of preference share, Calculate the market value of equity share and retained earning together and find out its weight. That will be market value weight. And if you will calculate weighted average cost of capital using market value weight, that will be WACC on the basis of market value. Market value is a true reflection of the value of a particular source of capital. So we should use market value weight. But easy method is to use book value weight. So these are some of the concept of cost of capital. So we will summarize our discussion now. What we have discussed? We have discussed cost of capital is the minimum acceptable rate of capital. It's the minimum rate which we must generate on the capital to maintain the value of the firm. If we generate an income less than cost of capital, if we generate an ROI less than cost of capital, the value of the firm will reduce. If you generate ROI more than cost of capital, the value of the firm will increase. So this is the minimum acceptable rate a firm must earn its cost of capital. The ROI should be minimum equal to cost of capital so that its value will not change. If it earn more than cost of capital, its value will increase. If it earn less than cost of capital, its value will decrease. Next, we have discussed cost of capital is the minimum expectation of the provider of capital. And cost of capital is the explicit cost. But in some case, we have to use implicit cost. Explicit cost is that discount rate which equates the inflows of an instrument with its outflow. But implicit cost is something which is based upon opportunity cost. Then we have discussed how to calculate cost of individual source of capital. We have discussed how to calculate cost of debt, cost of preference share, cost of equity. In cost of equity, there are many methods we have discussed. The methods may be earning price method, earning price plus growth method, dividend price method, dividend price plus growth method. But the most important method which is used for calculating cost of equity is beta coefficient method, or that is known as capital asset pricing model, CAPM method. It attaches risk with cost of equity. Then we have discussed a concept called computation of weighted average cost of capital or overall cost of capital or cost of capital of the entire organization. How it is calculated? We have discussed. First, we have to calculate cost of individual source of capital. Then we have to calculate weight of individual source of capital. Weight means importance, weight means proportion of investment, and we have to calculate cost of individual source. We have to calculate weight of individual source. Then we have to multiply cost with weight and we have to sum it, and we will get overall cost of capital, composite cost of capital, or weighted average cost of capital, or WACC of the firm. This is the summary. In our discussions, we have used some key words. First word we have discussed, cost of capital. Cost of capital, what is cost of capital? It is the minimum required rate which a firm must earn to maintain its value unchanged. Then we have discussed cost of debt. What is cost of debt? It's the interest paid with some adjustment of tax yield. That is cost of debt. Then we have discussed cost of equity capital. What is cost of equity capital? This is the minimum expectation of the equity shareholders. It is that discount rate which equates inflow associated with an equity with the outflow. Then we have discussed cost is attached with risk. What are the two type of risks? We have discussed regarding business risk and finance risk. What is business risk? It's the possibility that a firm may not able to operate successfully and earn profit. What is financial risk? It's the risk that the profit is not sufficient to pay the interest on loan or to pay dividends. Then we have discussed another concept, yield to maturity, YTM. YTM of a bond क्या है? It's the internal rate of return of the bond, IRR of the bond. It's the discount rate which equates current value of the debenture with the present value. It's the discount rate which equates the outflow of the debenture with its current market price. Then we have discussed a concept called beta. What is beta? Beta is a measure of systematic risk of the business. So we have discussed. Next, some important questions related to cost of capital. One question is, what is cost of capital? Why it is significant? We have discussed the importance of cost of capital. Another important question is, what is the difference between business risk and financial risk? Next, what is cost of debt? How it is calculated? How to calculate cost of preference share? These are some of the important questions. How you find out the cost of retained earning? Is retained earning cost free? No, retained earning is not cost free. It has opportunity cost. Then some practical problems are given in your module. You can solve these practical problems. Then one example is there. This particular example is very important. You can assignment, you can solve it at home. Calculate weighted average cost of capital using book value weight and market value weight. Book value is given, total book value is given. Market value is given, total market value is given. First, you have to calculate the weight. How weight will be calculated? Individual value by total value. First case weight will be 100 by 340. Next case weight will be 40 by 340. Next case weight will be 160 by 340. Like this. Next weight will be 40 by 340. You have to use all these concepts and find out the cost of capital. There are some important books you can follow for reading more on cost of capital. This is given in your syllabus. In your module, these are the books you can follow. I have followed these 3 books for calculating or 4 books for deciding the cost of capital. With this, I conclude my lecture on cost of capital. Thank you. Thank you for attending the class and listening to me. Thank you. Thank you all.